There is rumor that somebody, this is a rumor, tried to purchase and stand for delivery on $40 billion worth of silver, and bang, they shut down the CME, the COMEX, at 10 or 11 o'clock at night on Friday night, Thursday night, Thanksgiving night. Now, there's no volume going through these servers at this point, right?
The demand for industrial silver, the 1,000-ounce bars, is at a level that I have never seen before. And it's causing, in my view, or one of the main causes, to see a significant rise in the silver price. I would say on gold, I think 5,000's a gimme. I think it'll make it to at least that level. Could it make it to 10? Yes. Could it make it to 20? Yes. If you go from, let's say, the breakout at 2,000, if you took a factor of 5, you look at $10,000 gold over the next couple of years.
In this powerful market discussion, precious metals experts Andy Schectman and David Morgan break down one of the most explosive rumors shaking the silver market today. According to the conversation, a major buyer allegedly attempted to stand for delivery on $40 billion worth of silver, triggering an immediate reaction behind the scenes. Moments after this massive request, the CME and COMEX systems reportedly went offline late at night, during one of the slowest volume periods of the entire year. This strange timing has raised new questions about the true state of physical silver supplies. Industrial demand for 1,000-ounce bars is reportedly hitting levels never seen before, creating pressure that may be helping fuel the current surge in silver prices. With silver shortages becoming more visible, many analysts believe this could be the beginning of a much larger move. The discussion also highlights bold long-term projections for gold. If gold's breakout from $2,000 continues, a 5-fold move suggests potential targets of $10,000, and even higher levels are not being ruled out. As demand intensifies and supply tightens, the coming years may deliver some of the most dramatic moves the precious metals market has ever seen. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in. Now listen to the interview.
I mean, for the last 5, almost 6 years, I've been screaming about the deliveries in particular in London and on the COMEX, but mostly in London. I've been screaming about the central bankers buying gold and silver, but things have really changed, especially, I guess you could say, in silver, and especially here in the United States. Some of the big things that have happened, maybe the biggest thing, is that the United States government has classified silver as a critical mineral. Now, that's a very big deal. In other words, they're putting a floor, a policy floor, a national security floor under the price of silver. And they are acknowledging for the very first time that silver is incredibly important. Now, from a standpoint of what's interesting about that is that it's been the Western banks, 8 of them, half in the United States, half in Europe, roughly, that have held down or maintained the largest concentrated short position on COMEX in the history of the exchange in any of the 1,000 commodities traded in silver. Now, that's been going on for years, and I have my own beliefs behind it. I believe it is the military-industrial complex who rules the world through high-tech military components and the need for copious amounts of silver to make these components to sell to the Western governments around the world to rule the world, as they have for a very long time with very, very strong militaries. They are the ones that I think have been behind. The question is, why would 8 banks have the largest concentrated short position for years and years and years? JP Morgan, the custodian of the world's largest silver trust, SLV, paid the largest fine the Justice Department ever handed out for manipulating the market, the metals market, yet they're still allowed to be the custodian with BlackRock of the world's largest silver trust. Who is a military-industrial complex? Well, I would argue it's BlackRock. They own the majority of all the military manufacturing companies. What happens when gold goes higher and higher and higher and higher? The dollar gets devalued more and more and more and more. Remember we said the dollar's only down 9% against the basket of horseshit currencies, the dollar index, but it's down 70% against gold or more. So dollar is the real measuring stick of the valuation of the currency. Now, if you wanted to bring back manufacturing, Triffin's dilemma says, well, you can't do it. The dollar's too strong. So the first thing we want to do is make everyone no longer want to use the dollar. And when you talk about supply demand numbers, the Silver Institute will tell you we're running on average about a 200 to 300 million ounce shortfall for the last 6 years. This will be year number 6. 1.5 billion ounces short between supply and demand, and military is not in there. And they don't keep it down to make military componentry, because silver would go too high. Silver is a asset that is depleting in nature. Your skin is epidermis. Silver is found in nature in a form called epithermal, right near the surface. The big deposits were found decades ago. Last year, they mined about 850 million ounces. Of that, only about 170 million ounces came from silver miners, specifically. That's it, 20%. The rest come from byproduct mining of other metals altogether, where they stumble across it, have no vested interest in maximizing its price, and sell it to the marketplace, a little bit in recycling, not a lot.
There is a fact, that is that silver became a critical mineral recently for the United States. Critical really means strategic, and it was used basically for something that you have to have, especially in a strategic sense, meaning militarily. The strategic stockpile before it was turned into Silver Eagles and sent out to the U.S. Treasury to mint was 139 million ounces. So if we go back to that kind of a level over the next few years, that's a further demand on the silver pile that exists that's shrinking year over year. So that's one. The other one is India has become much more into the silver market. They always have been, but of late they have been very, very large purchasers of silver. In fact, they have a similar ETF to what we know as the SLV or PSLV, where it's physically backed by silver, and they cannot actually get the amount of physical they want at this time to back up new shares of their ETF. That can be pointed to as a fact. Another one is Russia has bought into silver, not necessarily from a monetary perspective, but from a strategic asset perspective. And I would say that would be another one. And you can also look at the Saudis bought about 1 million shares of the SLV recently. And of course, that sounds like a lot for you and I, but for them, 1 million shares is not very much. But nonetheless, it does show that there is a nation state willing to take a stake in silver. And that is not a first, but it's a first in this bull market.
In this powerful deep dive on the precious metals market, experts Andy Schectman and David Morgan reveal the major forces reshaping silver and gold like never before. For nearly 6 years, the warnings about physical deliveries, especially in London and on the COMEX, have been growing louder. But now, the landscape has shifted dramatically. One of the biggest developments is that the U.S. government has officially classified silver as a critical mineral, placing a national security floor under its price and acknowledging its strategic importance for the first time in modern history. This comes at a time when 8 Western banks, split between the U.S. and Europe, have held the largest concentrated short position in the history of COMEX across any commodity. Questions continue to swirl about why these massive short positions exist and who benefits from keeping silver's price suppressed. Industrial demand is surging, military consumption isn't even counted in official supply and demand numbers, and the Silver Institute reports a persistent 200 to 300 million ounce annual deficit for 6 consecutive years. Meanwhile, global interest is rising fast. India cannot secure enough physical silver to properly back its ETF. Russia is viewing silver as a strategic asset. Even Saudi Arabia recently purchased a significant SLV position, signaling growing nation-state interest. With shrinking supply, expanding global demand, and silver's new strategic designation, the pressure on the physical market is reaching historic levels. Let's get into the interview.
All markets move at the margin, as you know, and the margin for silver is at the monetary demand. But the industrial demand has gone up very, very rapidly. In the last 25 years, which sounds like a lot, but in human terms, but in monetary terms, it's nothing. So if you go back 25 years ago, 35% of the market was industrial demand. And at that time, we only mined 550 million ounces on an annual basis. Today, industrial demand is probably pushing 70%, and we mine 850 million ounces now. So think about that. The amount of demand 25 years ago was 30 of 50, so maybe a couple, 250 million ounces. Now, 70% of 9 is like 600 million. So that doesn't go away. Now, in a big recession or a global contraction, it could mitigate it somewhat, but not that much really. Now, the calling card is the monetary demand. And that's where the retail has backed off. I just checked again today with a couple of the big wholesalers, and they're still buying back more silver from retail than they're selling. But bigger institutions, as you outlined, Michelle, are buying silver for monetary purposes. And the industrial demand, I think, is where I've talked about for years, which means when that point in time happens, where industry and monetary demand come together at the same time, we are going to see an explosion in the silver price. And it's basically more industrial right now, I'd say, than monetary, at least from the retail side. But both demands are there and accelerating. And this is something that in a very small market like silver, you could see these extreme moves, which you've seen the last 3 or 4 days, where we go from, it hit 54 and it comes right back down to the 50-day moving average. And then all of a sudden it goes past 54, we're sitting near 60. And that's the silver market. The real silver market, not only being run by derivatives, but the fact that 1,000-ounce commercial bars are the true silver market. In other words, that's the price that's discovered by the contracts sold on the futures exchange. It's there in London, it's in New York, and of course there's the Shanghai Gold Exchange that does something similar. There are other smaller markets. And so I think the misunderstanding can be that what drives the silver market is perhaps the retail investor buying silver. Certainly that has an effect, but the real effect is the commercial bar market. And we're in a position now that is what's new is that demand for commercial bars exceeds the supply. Is it momentarily or is it from now on? I do not know. What I do know is momentarily, meaning the past few months, there's been a mismatch between the amount of physical silver available at the right location at the right time. And this has produced discrepancies in price discovery, meaning that there's an arbitrage opportunity. Arbitrage means it's a given commodity or stock or house or whatever that's identical or fungible, and it has a different price in a different area. And so you take the product to the new area and get a higher price for it. That's an arbitrage. And that's been happening in silver a few times here lately, which is rare to take place, especially this often. And we're seeing that reconciled, perhaps momentarily, with what's taken place here recently. I think the bottom line, to summarize it, Michelle, would be this.
As the landscape of precious metals continues to evolve, it's becoming increasingly clear that silver is entering a historic tightening phase. Industrial consumption has surged far beyond levels seen just a couple of decades ago, and the market has transformed from a 35% industrial footprint to nearly 70% today. With production failing to keep pace and commercial-grade bars now facing consistent shortages, the silver market is revealing structural cracks that cannot be ignored. What makes this moment even more significant is the simultaneous rise in monetary interest. While retail participation has slowed, larger institutions are stepping in with strategic intent, seeking silver not as a short-term trade, but as a long-term monetary hedge. When institutional monetary demand collides with already elevated industrial consumption, the setup for extreme price movements becomes undeniable. Recent volatility, sharp rallies, sudden pullbacks, and rapid breakouts reflects a market struggling to reconcile limited physical availability with surging global appetite. Arbitrage opportunities appearing across international exchanges further highlight the disconnect between paper and physical markets. All signs point to a silver environment where tightness, inconsistency in supply, and expanding strategic interest could trigger dramatic pricing shifts far sooner than most expect. If you found this helpful, like, share, and subscribe to The Metal Bar. Turn on the bell so you don't miss any updates, and comment below to share your thoughts on it. Appreciate you for tuning in.